Welcome back. Well, it's going to be rough at the start of trading this morning. Investors in for a wild ride. Dow Industrials right now down 1.5%. That's 376 points lower. This is inching toward the lows again, down 376 on the Dow, down 87 on the NASDAQ. That's 1.25%. So things have worsened in the last 20 minutes after President Trump has threatened another round of tariffs against China. Joining us now is Wells Fargo Investment Institute head and global market strategist, Paul Christopher. Paul, good to see you. Thanks so much for joining us.
Thank you, Maria.
How serious is this?
This is part of the overall increase in volatility that we've been looking for. As an issue in and of itself, what it shows us is that investors were originally thinking, oh, well, it's just a negotiating ploy. Well, yes, it is a negotiating ploy, but it's probably going to be a harder negotiation than investors were originally thinking. You still got a lot of institutional investors holding currencies and equities in places like Korea, Mexico, Taiwan that are very vulnerable.
Yeah, but you just said, I'm expecting higher highs this year and higher highs next year.
We are expecting higher highs this year and next year, but with a lot of volatility in between on days like this.
Well, you've also seen investors kind of rotate in the last month into some of the higher yielding sectors like real estate, utilities, even consumer staples has done a little better. Do you think you should get some exposure to that right here, right now, just to kind of help yourself as an investor really wade till we get to the higher highs?
We've been underweight most of the interest rate sensitive stuff, and we finally got out of REITs when we had that nice pullback for the last couple of months, because we see increased sensitivity to rates in all of those sectors across the board. We'd be pulling from there and putting into cyclical sectors. We still believe the economy has good growth this year and next.
Let me welcome Susan Lee to the conversation. Thanks for joining us, Susan. And I know you've been on the phone with strategists in the U.S. as well as China this morning.
Yeah, I made some calls around the big trading desks across the Asia Pacific, and they tell me that it really wasn't that hard to drag down China, to be honest. I mean, we were in a tightening cycle anyways, where they were trying to clamp down on credit, making off-sheet credit and loans, putting them on to the books of banks, right? So it was already in a tightening cycle. We had disappointing macro data, and this whole talk of trade tariffs and this trade war, really it was an excuse for them to sell. And, it's not a one-day event, because there was the biggest fund outflows that they've seen in years in the Asia Pacific, ETF unwinding. And when mom and pop and retail investors start unwinding, that event is not a one-day event. It's not a weekly event. It's probably months in order for them just to sell out of the market for these, these massive passive funds, right? So right now it's concerning, especially as we're looking at the worst sell-off since 2016. I was there in 2016 when China went down 6-7% day after day, and they're concerned that if in this environment where there isn't that much cushioning, it could get a lot worse.
I just wonder if you really should be thinking about how you're going to get out of this market. I mean, maybe you just hold on. I don't know. What do you think? What are you telling clients this morning?
What you really have to do at this point is, first of all, make sure you have some dry powder. Take those profits where you can. If you're overweight, if you're higher than where you want to be, take some profits, keep some dry powder for the next round of pullbacks like we're seeing today. You're going to have more of that to take advantage of. It's a higher bet to bet on the economy growing at this point.
Why not just keep it in cash? If the Federal Reserve continues to raise interest rates, your cash is earning a lot more, and you don't have the volatility certainly that you see not just in U.S. stocks, but we're talking about real uncertainty and weakness globally. And that's one of the things that, in terms of which could cause a great unwinding, is we've talked about the emerging markets here, and is enough attention being paid there, and what's going on in nations like Brazil, and even weakness in developed markets across Europe.
Well, I'd love to get your take, because the concern is now we're expected to have 4 rate hikes this year from the Fed, but interestingly, this trade war spats has really helped to hold inflation down. So where do you see interest rates going? What is the risk around the world to that? And how do you play that?
Interest rates are rising, but gradually. The levels don't really matter for stocks yet. Stocks are still very competitive compared to bonds at levels. If rates continue to rise gradually, we've still got more time to be in stocks. But we don't disagree. We would be moving money out of long duration, long maturity bonds into shorter duration bonds as rates rise.
That's what's been happening, because you've seen the yield on the 10-year just come way down. I forget where it was. It was at 2.8 8% last night, I think.
Right. That's a good place to take some money, rotate it back into shorter term.
But aren't tariffs, I mean, isn't that inflationary? And
Ultimately, they would be, but think about it. We still have very selected groups of tariffs. Even $200 billion is not that large an increase or a hit to the Chinese economy. If you want to see a real trade war, it's 60% tariffs across everything. That's what we had in 1930. It's corroborated by academic research as well. You really have to get up that high to have a trade war. We're not there yet. It's right to be concerned, but we're not there yet.
All right, you're not as worried as some others. Real quick, are you expecting a slowdown for the consumer in the next quarter?
No, we're not. It's solid consumer sentiment, solid consumer buying, good wage growth. Look, wages are still rising faster than inflation.
Yeah, I couldn't believe Macy's stock the other day when I took a look at it. And when it's done over the last couple of months, just indicating a stronger consumer. I mean, that's not what we're hearing. There's a narrative going around that the consumer does slow down, but you're not buying it. It's good to see you, Paul.
Thanks, Maria.
Thanks so much for joining us. Paul Christopher there, Wells Fargo.